Good evening, everyone. Let's take a closer look at today's global market action. This was a day of sharp structural divergence, not a one-way rally, and not a broad risk-off move either. Chinese equities were the clear standout, with the Chi-Next index surging 3.06%, the Shenzhen Component Index up 2.21%, and the Shanghai Composite gaining a more modest 0.72%. The dominant theme was semiconductor equipment and domestic substitution, directly triggered by the new U.S. export controls on advanced chipmaking tools, which the market interpreted as a catalyst for accelerating local replacement. On the U.S. side, the three major indices closed higher in the previous session, with the Nasdaq up 1%, the S&P 500 up 0.7%, and the Dow up 0.53%. But futures turned lower in pre-market trading today, with Nasdaq futures down 0.9%, pointing to profit-taking in big tech after earnings. Capital flows today showed a rare divergence. Some money continued to move into Chinese tech and growth names, while another stream rotated into energy. Oil was the big mover, with WTI surging 6.52% and Brent up 3.59%, driven by the attack on Saudi oil facilities, which injected a fresh geopolitical risk premium into supply. Cryptocurrencies were the weakest link. Bitcoin fell 2.93%, Ethereum dropped 3.33%, and related ETFs also declined. What's notable is that risk appetite is clearly fractured. Money is not systematically moving into safe havens. Gold fell nearly 1%, and the 10-year Treasury yield rose to 4.74%, which tells us the market is pricing reflation, not recession, and not fear. On the currency side, the dollar index eased to 99.8, while the offshore yuan stayed stable around 6.75, providing external support for Chinese risk assets. Foreign capital has not fled renminbi assets despite U.S.-China tech tensions, which suggests the tariff delay to mid-August is indeed reducing tail risk. The core issue now is that China's semiconductor equipment and materials sector is starting to price independently from U.S. tech stocks. The domestic substitution narrative has shifted from thematic speculation to order verification, and this signal needs 5 consecutive trading days to confirm. Looking ahead to tomorrow, there are 3 key things to watch. First, whether the Nasdaq can hold above pre-market levels once U.S. trading begins. If it falls more than 1.5%, Chinese markets could face external pressure on Monday. Second, whether the 10-year Treasury yield breaks above 4.8%, which is a critical valuation threshold for growth stocks. Third, whether WTI can stay above $85, which will determine if the energy trade continues. Overall, today's session is best described as structural differentiation. The strategy is to stay selective, keep positions controlled, and focus only on structural long opportunities in China's A-share market. Avoid chasing U.S. futures to the downside and avoid chasing energy at these levels. In short, the market is repricing, and direction matters more than speed.